Welcome to our deep dive into the lives and lessons of two of the most revered figures in the world of investing, Warren Buffett and Charlie Munger. Collectively, these legends bring nearly 2 centuries of financial wisdom to the table, guiding Berkshire Hathaway to unparalleled success in the stock market. Warren Buffett, known as the Oracle of Omaha, and his less publicized but equally astute partner, Charlie Munger, have become synonyms for successful long-term value investing. Today, we aim to unravel the essence of their financial expertise, distilling decades of investment acumen into key lessons that you can apply. Join us as we explore the profound insights and strategies that helped shape Buffett and Munger into the financial giants they are today. Stay tuned as we unlock a century of financial wisdom, ensuring you walk away with valuable knowledge to enhance your own investment journey. Warren Buffett and Charlie Munger are not only partners in business but kindred spirits in philosophy, each carving out a distinct yet converging path through the financial landscape from an early age. Warren Buffett began his journey in Omaha, Nebraska, where he developed a keen interest in business and investing in his youth, delivering newspapers and owning his first stock at just 11 years old. He honed his craft at Columbia Business School under Benjamin Graham, the father of value investing. Charlie Munger, on the other hand, hails from Omaha as well but took a slightly different initial path, focusing on meteorology in the U.S. Army Air Corps and later graduating from Harvard Law School. His interest in investment, however, drew him towards real estate and eventually to meet Buffett. The two were introduced at a dinner in 1959, and their mutual interest in investment philosophy quickly solidified into a formidable partnership. Berkshire Hathaway itself began as a struggling New England textile company when Buffett began buying its stocks in the early 1960s, eventually taking control of the company. The decision to shift from textile manufacturing to insurance and other investments marked the first major transformation under their guidance. It was Munger who advised Buffett to look beyond the declining textile business, prompting strategic investments in media, insurance, and consumer goods, which laid the foundation for what Berkshire Hathaway is today, a conglomerate with a massive portfolio of high-performing assets. Their journey together transformed Berkshire Hathaway from an obscure textile mill into a global powerhouse, demonstrating their extraordinary vision and unmatched understanding of business and investment. This legacy of strategic decisions not only reshaped their company but also the entire landscape of investment. Investment philosophy. Warren Buffett and Charlie Munger's investment philosophy is deeply rooted in the principles of value investing, a strategy developed by Buffett's mentor, Benjamin Graham. This approach focuses on finding undervalued stocks that trade for less than their intrinsic values and holding them for a long time. Buffett and Munger have adapted and evolved this philosophy over the decades, emphasizing not just price, but the quality of the business. Core principles. Business understanding. Buffett and Munger invest only in businesses they thoroughly understand, often quipping that an investor should be able to explain the business model on a single piece of paper. This rule ensures that they maintain a portfolio of companies whose operations and market environments are clear to them, reducing investment risk. Economic moat. They look for companies with a durable competitive advantage, or economic moat, which can sustain profits against competitors. This might be a strong brand identity, proprietary technology, or regulatory advantages. Management quality. High-caliber management is crucial. They invest in companies led by executives who are not only adept at operations but also allocate capital wisely. Financial health. A strong balance sheet, good return on equity, and consistent profit margins are characteristics Buffett and Munger seek out, indicative of a financially sound company. Value. They seek companies priced below their intrinsic value, providing a margin of safety. This disparity between price and value creates the potential for substantial returns. Contrast with other investment trends. Over the decades, while speculative trends such as the dot-com bubble or the real estate boom led many investors astray, Buffett and Munger maintained their disciplined approach. They avoided hot stocks and sectors they did not understand, regardless of the prevailing market euphoria. For instance, during the tech bubble, Buffett was criticized for not investing in technology stocks, which he admittedly did not fully understand. His caution was vindicated when the bubble burst in the early 2000s. This adherence to value investing, with a focus on long-term ownership of high-quality businesses, contrasts sharply with strategies that chase short-term gains based on market trends or speculative forecasts. Buffett and Munger's success underscores the effectiveness of their disciplined, principled approach in various market conditions, affirming their legendary status in the investment world. Notable investments. Warren Buffett and Charlie Munger's investment portfolio showcases a series of strategic decisions that exemplify their value investing philosophy, with notable successes in companies such as Coca-Cola, American Express, and Apple. Each of these investments underscores their criteria for strong brand identity, consumer loyalty, and robust financial health, traits that promise long-term growth and stability. Coca-Cola is a quintessential example of their investment strategy. Buffett was attracted to Coca-Cola not only because of its intrinsic value but also its global brand recognition and wide economic moat due to consumer loyalty. He recognized that Coke products would be in demand regardless of economic fluctuations, providing a reliable and growing profit stream over decades. American Express showcased their principle of investing in businesses during temporary setbacks when they are still fundamentally strong. After the 1963 salad oil scandal, American Express shares plummeted, but Buffett, seeing the intrinsic strength and market position of the company, invested heavily, resulting in substantial long-term gains. Apple, a more recent addition to Berkshire Hathaway's portfolio, may seem an outlier in Buffett's traditional investment pattern. However, it aligns perfectly with his value principles, considering Apple's immense brand strength, loyal customer base, and significant cash flows. On the flip side, not all investments bore fruit. For example, Buffett's investment in the British retailer Tesco and the airline sector reflected miscalculations. Tesco suffered from intense market competition and internal mismanagement, leading to significant losses. The airline investment initially resulted in losses due to the sector's high operational costs and economic sensitivity. These experiences reinforced the importance of understanding sector-specific risks and the dynamics of consumer behavior more deeply. Through both their triumphs and setbacks, Buffett and Munger have demonstrated a consistent willingness to learn and adapt their strategies, ensuring their approach remains relevant and resilient across changing economic landscapes. Wisdom on market psychology. Warren Buffett and Charlie Munger have often emphasized the crucial role of psychological discipline in investing. They advocate for an approach that is counter to the reactionary impulses that dominate market behaviors, fear and greed. According to Buffett and Munger, successful investing requires detachment from the market's emotional environment to make rational, long-term decisions. One of Buffett's most famous quotes encapsulates this philosophy: "Be fearful when others are greedy, and greedy when others are fearful." This statement highlights the tendency of markets to fluctuate between extremes of optimism and pessimism, often driven more by herd mentality than by underlying economic fundamentals. Buffett and Munger suggest that the best opportunities arise when investors are able to act counter to prevailing market sentiments. Another profound insight from Munger is, the big money is not in the buying and the selling, but in the waiting. This reflects their belief in patience as an investment virtue. They argue that many investors harm their own returns by frequently trading to chase gains, whereas substantial wealth is built through the compounding of returns on well-chosen, long-held investments. These perspectives teach that mastering one's emotions is as important as mastering the fundamentals of investment. By adhering to a philosophy that promotes rationality over reactivity, Buffett and Munger have not only safeguarded their investments against volatile market swings but have also capitalized on the misjudgments of others driven by fear and greed. Long-term strategic thinking. Warren Buffett and Charlie Munger's investment success is heavily predicated on their commitment to long-term strategic thinking, with a clear focus on the power of compound interest. They champion the concept of buying and holding as not merely a strategy but a philosophy, embodying the patience required to allow investments to grow through the magic of compounding. Buffett often refers to compound interest as the eighth wonder of the world, advocating for its unmatched ability to accumulate wealth over time. This approach requires an investor to remain invested in high-quality stocks over many decades, benefiting from the reinvestment of earnings and the exponential growth of initial capital. For instance, Berkshire Hathaway's long-held positions in companies like Coca-Cola and Wells Fargo have demonstrated how disciplined reinvestment and patience contribute significantly to wealth accumulation. Their preference for a perpetual investment horizon stems from a belief in the enduring value of well-chosen businesses. Buffett and Munger view their investments as part ownership of companies rather than mere stocks to be traded. This perspective encourages them to think like business owners, focusing on the long-term health and performance of the company rather than short-term market fluctuations. This long-term orientation not only stabilizes their portfolio but also aligns with their value investing principles, allowing them to make decisions based on business fundamentals and intrinsic value rather than market timing. This strategy has proven to be a cornerstone of their monumental investment success, showcasing the practical power of patience and foresight in building sustainable wealth. Warren Buffett and Charlie Munger have articulated profound views on wealth and its responsibilities. They believe that with great wealth comes the obligation to contribute positively to society. Buffett's pledge to donate the majority of his fortune to philanthropic causes through the Giving Pledge, which he co-founded, reflects this belief. Munger has similarly contributed significant amounts to educational and research institutions. Their approach to wealth extends to their stewardship of investor capital at Berkshire Hathaway, where they prioritize ethical management and long-term value creation over short-term gains. This commitment is evident in their transparent communication with shareholders and their prudent management strategies. Looking ahead, they have carefully planned for Berkshire Hathaway's future without them. They've appointed successors who they believe will uphold their investment philosophy and maintain the company's culture. This ensures that their legacy of thoughtful, principled investing and their commitment to social responsibility endure beyond their lifetimes. The wisdom of Warren Buffett and Charlie Munger provides invaluable lessons for any investor aiming to navigate the complex markets of today. Key takeaways include: invest in what you know. Focus on companies whose business models and operations are clear and understandable to you. This reduces risk and enhances your ability to make informed decisions. Seek value and quality. Always look for companies that are undervalued relative to their intrinsic quality, ensuring a margin of safety and a potential for significant long-term growth. Embrace patience. Resist the urge to react to short-term market volatility. Long-term wealth is built through steady accumulation and the power of compound interest. Patience allows you to benefit from the growth of fundamentally strong businesses. Be contrarian when needed. Have the courage to buy when others are fearful, and be cautious when others are overly optimistic. This approach can lead to acquiring or increasing stakes in high-quality assets at lower prices. Plan for the long term. Consider investments with the perspective of holding them indefinitely, focusing on their long-term return potential rather than short-term price movements. If you're looking to build wealth and achieve financial independence, consider these principles as your foundation. Don't forget to like, subscribe, and click the notification bell for more insights that can help you grow your investment knowledge and succeed in the financial world. Join us next time for more financial wisdom.